What's up, crypto fiends? Average crypto investor, aka someone else's exit liquidity, here to talk about decentralized exchanges. On this channel, I like to demystify crypto terminology in a digestible format for some of the most popular terms that you need to know. Decentralized exchanges, or DEXs as they're better known as, are the lifeblood of decentralized finance and have been the backbone of the boom we have seen over the past few years. But what exactly is a DEX and how do they work? Well, on today's episode of Crypto Terminology Demystified, we're going to be explaining exactly that. As always, nothing said in this video is financial advice, and you should always do your own research before investing into any project. Most people's first foray into crypto comes through an exchange of some sort. Whether that is buying Bitcoin on Cash App, investing into Dogecoin on Robinhood, or buying some Ethereum on Coinbase, all of which I'll have a link for down in the description below, you have to get started somewhere. Unfortunately, most of these exchanges have limited offerings and even more limited services around them. That is because these are centralized exchanges, or exchanges that are run by one central authority. There is a famous saying in crypto, not your keys, not your coins, and this rings true for centralized exchanges. They are going to be subject to government regulation and intervention just like any other bank or centralized authority. The flip side of that coin is that these exchanges often have less risk of fraud associated with them and have a team of support agents to help you when an error pops up. But what if you want to buy coin that isn't listed on a centralized exchange or want to move your crypto to a wallet that the government can't interfere with? This is where decentralized wallets and exchanges come into play. Decentralized wallets are another topic for another video, but one of the most common wallets for interacting with DeFi protocols is MetaMask, thanks to its ease of use. Once you have your wallet set up with the correct blockchain that you want to use, you can then transfer your tokens from your centralized exchange account into your own personal wallet. This is where the fun really starts to begin. Unfortunately, centralized exchanges are still needed because they provide the best access to on and off ramps for fiat conversions. Once you have your native tokens for your blockchain or stablecoins in your wallet, we can begin exploring the world of decentralized finance. The first stop is usually a decentralized exchange, also known as a DEX. A DEX is like the stock exchange, but for cryptocurrency on the blockchain that is on. On a stock exchange, you might have Apple stock, but you really want to buy some Amazon stock. So you sell your Apple stock to market makers who in exchange sell it to buyers, and you buy your Amazon stock from other market makers who in exchange bought it from another entity. These exchanges are generally done on what is called an order book, which lists the bids or prices people are willing to pay, and asks, or prices at which people are willing to sell. Once a bid matches up with an ask, then the transaction is completed and both parties receives their assets. A DEX works a little bit differently. You may remember in the video about impermanent loss that we discussed the automated market maker model when talking about liquidity pools. If you haven't had a chance to check out that video, it will be linked right here. This is the technology that not only allows a DEX to work smoothly, but really function at all. Whenever a new token wants to be listed on a DEX, it needs to create a liquidity pair or a partnership with a base currency. Think of this like setting the initial price of the token. Let's go and say that we want to create the average crypto investor coin and we want it to be worth $100. We could go and pair 1,000 average crypto investor tokens, which we will call ACI, with 100,000 USDC, which is a stablecoin pegged to $1. This would create our ACI-USDC liquidity supply and set our initial price at $100. We then would supply these liquidity tokens to a decentralized exchange like SushiSwap so other people can go and get themselves some sweet ACI tokens. Let's say our first buyer comes in and says $100 seems like a fair price, so they pay 100 USDC for one ACI token. Now our liquidity pool will have 999 ACI tokens and 100,100 USDC. This raises the price of our ACI token to $100.20 because 100,100 divided by 999 is $100.20. Now if someone else comes in and sells one ACI token, this would bring us back to our initial supply. This is a simplification of the process, but you get the general idea. Decentralized exchanges use these liquidity tokens to be able to facilitate exchanges between tokens without having to keep an order book. You retain access to your tokens and only give them up when the transaction is actually being completed. This is vital to the decentralized finance space because again, not your keys, not your coins. Decentralized exchanges also allow users to participate in these liquidity pools to earn fees as well as getting new projects in front of more people by facilitating the trading. Some of these popular exchanges have even branched out into offering lending, staking, and launching their own tokens to generate revenue. Ultimately, they are probably the most useful tool in the DeFi space. Have you exchanged coins on a DEX before? How did it go and what was the experience like? Let me know in the comments down below. Also, if there are any other terms that you would like me to try and demystify, let me know. As always, don't forget to like the video and subscribe with the bell notification turned on so you can be alerted when my next video goes live. That's all for now, stay safe, and don't worry crypto fiends, we are all going to make it.